Hello and welcome to SRA Accounts Rules Compliance. This is part 2 in a series of webinars. Hopefully you've already seen part 1. I'm Faye and I'm joined again by my colleague Jenny. Our contact details are on the screen, so feel free to get in touch if you have any questions on this webinar or related topics. Today we are going to cover the concept of materiality, common reportable breaches, and how to identify and correct breaches.
Breaches of the SRA Accounts Rules must be reported to the SRA if they are material. The SRA has issued guidance giving factors leading to reportable breaches. Examples of these are a significant or unreplaced shortfall on the client's accounts, evidence of the willful disregard for the sake of client's money, actual or suspected fraud or dishonesty by individuals within the practice, material breaches not reported to the SRA, a lack of adequate accounting records, incorrect client account reconciliations, and the client account being used as a banking facility.
Let's now consider the most common reportable breaches. Last year, Hazlewoods prepared accountants reports for 88 law firms. Of these reports, 38 included reportable breaches. That's 43% reports submitted.
So what's most likely to make your report qualified? Well, the top 3 reportable breaches we noted last year were residual balances, Rule 14.3. This was included on 30 reports. Incorrect use of a suspense account, Rule 29.25, which was included on 12 reports. And acting as a bank, Rule 14.5. This was included in 5 reports. We're now going to consider each of these in turn.
The most reportable breach we noted last year was Rule 14.3, which relates to residual client balances. The rule states, client money must be returned to the client or other person on whose behalf the money is held promptly as soon as there is no longer any proper reason to retain those funds. Payments received after you have already accounted to the client, for example by way of a refund, must be paid to the client promptly. In order to comply with Rule 14.3, you should ensure client funds are returned promptly on completion of matters. The rules do not define promptly, and this requires your judgment. The balances we picked up on were commonly small amounts, and often breaches occur when cheque payments expire and they're not reissued. There is no longer any distinction between pre- and post-2008 balances. This is included in the 1998 rules, not the 2011 rules. All balances must be considered and returned to clients, irrespective of when they arose.
If funds are not returned promptly for whatever reason, Rule 14.4 comes into play. You must promptly inform a client in writing of the amount of any client money retained at the end of a matter, or the substantial conclusion of a matter, and the reason for that retention. You must inform the client or other person in writing at least once every 12 months thereafter of the amount of client money still held and the reason for the retention for as long as you continue to hold that money. You need to be careful here though, as the firm must not provide banking facilities. There has to be an underlying transaction, and there's more on this later.
Of the 38 accountants reports which were qualified last year, 30 of these included reportable breaches in relation to residual client balances. The breach would only be reportable where there is no evidence that you are trying to return the balances to clients. You should note that a firm has recently been fined £20,000 for not dealing with its residual balances.
So, how should a practice deal with residual balances? Practices are required to make reasonable attempts to establish the identity of the owner and ascertain the proper destination of money and return it to the rightful owner. You must not be put up. You do not need to make these attempts if the cost of doing so is excessive. Unfortunately, excessive does not include fee earner or other staff's time. If you incur costs such as tracing agents' fees, you must get permission from the SRA before you take payment from the client money. If the practice has made reasonable attempts to return the balances to clients, it may consider donating them. Amounts less than £500 do not require any prior authorisation from the SRA, but amounts
greater than £500 do require prior authorisation and possibly a supporting letter from your accountant. If you do donate funds, they must be donated to a registered charity, and the charity should offer an indemnity. In all cases, you must keep a record of the steps taken to return the funds and keep a central register of all funds donated to charity.
The next most common reportable breach that we saw was incorrect use of a suspense account, or Rule 29.25. The rules state that a suspense client ledger account may be used only when you can justify their use. For instance, for temporary use on receipt of an unidentified payment, if time is needed to establish the nature of the payment or the identity of the client. You must ensure limited use of suspense ledgers. Suspense ledgers should only be used as a temporary measure and not as a dumping ground for old amounts. The more there are, the harder they are to identify and clear. Too many indicates a controls weakness. Regular reviews are necessary to ensure the balances can be easily reconciled. You should also avoid miscellaneous ledgers for multiple clients.
Of the 38 accountants' reports which were qualified last year, 12 of these included reportable breaches in relation to the incorrect use of a suspense account. This breach is reportable where suspense ledgers have old unidentified balances on them and there is no evidence that anything has been done to identify the clients and either allocate them to correct ledgers or return them to their sources.
If you have a suspense account made up of lots of old balances, you should work to reconcile the balances, return the balances to either clients where possible, or where the client cannot be identified, return them to the sender. If no further information is available, apply to donate them to the charity, as we've previously discussed.
The third most reportable breach we noted was acting as a bank, so Rule 14.5. The rule states, you must not provide banking facilities through a client account. Payments into and transfers or withdrawals from a client account must be in respect of instructions relating to an underlying transaction and the funds arise from or to a service forming part of your normal regulated activities. Guidance Note 5 to Rule 14.5 states that Rule 14.5 reflects decisions of the Solicitor's Disciplinary Tribunal that it is not a proper part of a solicitor's everyday business or practice to operate a banking facility for third parties. It should also be noted that any exemption under the Financial Services and Markets Act 2000 is likely to be lost if a deposit is taken in circumstances which do not form part of your practice.
The SRA states that allowing your firm's bank account to be used as a banking facility may involve a breach of the SRA's principles. Principle 1. Upholding the rule of law and the proper administration of justice. Principle 3. Not allowing your independence to be compromised. Principle 6. Behaving in a way that maintains the trust the public places in you and the provision of legal services. And Principle 8. Running your business or carrying out your role in the business effectively and in accordance with proper governance and sound financial and risk management principles.
There are a number of risks associated with acting as a bank. You should bear that providing banking facilities through a client account is objectionable. For the avoidance of any doubt, the SRA's view is that you should only receive funds into client account in relation to an underlying transaction that you or your firm is advising on. It's objectionable because solicitors are qualified and regulated in relation to their activities as solicitors and are held out by the profession as being regulated in relation to such activities. They are not qualified to act as bankers and are not regulated as bankers.
There must be a reasonable connection between the underlying legal transaction and the payments. Whether there's a reasonable connection is likely to depend on the facts of each case. The fact that you have a retainer with a client does not give you license to process funds freely through a client's account on the client's behalf. You should question why you're being asked to receive funds and for what purpose. You should only hold funds where necessary for the purpose of carrying out your client's instructions in connection with an underlying transaction. You should always ask why the client cannot make the payment him or herself. The client's convenience is not the paramount concern. If the client does not have a bank account in the UK, this considerably increases risks. You should be prepared to justify any decision to hold or move client money to the SRA where necessary.
There is also the risk of money laundering. Allowing a client account to be used as a banking facility carries with it the obvious risk that the account may be used unscrupulously by the client for money laundering. You should be aware that criminals often target solicitors' client accounts to lend credibility to fraudulent schemes or to launder the proceeds of their criminal activity. You should ensure that you undertake proper due diligence before accepting any funds into client account, and you should not act if you do not fully understand the transaction on which you are advising. Compliance with Rule 14.5 offers an important first line of defence to clients who may seek to take advantage of your client account to launder money.
We thought we would give you some examples that we have personally seen. The first one is rent deposits. We've corresponded with the SRA, and they've confirmed that holding rent deposits is considered to be acting as a banking facility in breach of Rule 14.5. Their recommendation is that the funds are held in joint accounts rather than the general client accounts. Next one, investment property management. We work for a firm who was appointed to manage the property portfolio of a client, which involves collecting the rents and paying the utilities and expenses of managing the buildings. We contacted the SRA in January 2017, who could not confirm whether this constituted a breach of Rule 14.5 or not. The last one, deputyship monies, for example, a power of attorney matter where care home fees are being expended on a regular basis. There are certain situations which may arise with incapacitated clients who are in homes, and it may take a while to sort out banking facilities. Unfortunately, the rules do not accommodate these delays, and so you will be in breach by default. There are several case studies on the SRA's website, and we understand that the SRA is in the process of updating its guidance on Rule 14.5. In the meantime, please do contact us if you'd like any further guidance or assistance with this.
Thank you for listening. Please keep an eye out for Part 3 in this series. This covers common breaches of the SRA Accounts Rules. Our contact details are on the screen, so please do get in touch if you have any questions.